The stock market managed to end Friday on a positive note, but do not let one green day fool you. The major indexes still lost ground for the week. Interest rates moved higher, oil prices climbed, and the latest Federal Reserve minutes showed something we haven't seen much of lately, a genuinely divided Fed. So what actually happened, and what, if anything, should you do about it? Let's slow the noise down. Hi, I'm Stephanie. This is your Money with Stephanie weekly market roundup, where we talk about what happened in the markets, why it matters, and what it may mean for your real life money. And remember, this is education only. It's not financial tax or legal advice. And it's definitely not a prediction of what the market will do next. First, the market itself. The S&P 500 closed Friday. It was up about 0.4% for the day, but down about 1.4% for the full week. The NASDAQ Composite closed at 26,180 roughly. It also rose about 0.4% Friday, but lost just over 2% for the week. And the Dow finished Friday up nearly 1% for the day, but it too ended the week lower. Plainly said, Friday gave investors a little relief, but it didn't erase this week's losses. And here's an important bit of perspective. A 1 or 2% weekly move is not a market emergency. It feels much bigger when you watch every headline and every tick of the market, but normal investing includes uncomfortable weeks. The more useful question is not, was the market red? It's, what was the market reacting to? One major answer was interest rates. The 10-year Treasury yield ended Friday at 4.7%, according to the U.S. Treasury. And that matters because the 10-year yield touches all kinds of real-world financial decisions, from mortgage rates and business borrowing to the way investors value stocks. When safer government bonds offer higher yields, investors may be less willing to pay very high prices for stocks, especially expensive growth and technology stocks whose expected profits may be years in the future. So that helps explain why the technology-heavy NASDAQ had a rougher week than the S&P 500. Now, this does not mean rates went up, so sell your technology stocks. Not at all. Please do not reduce investing to a financial version of whack-a-mole. It means that higher rates can create pressure, and that pressure may not affect every part of the market equally. For people approaching retirement, there's another side to this story. Higher yields may create more attractive income opportunities in cash, CDs, treasuries, and high-quality bonds than investors had for many years. But attractive is not the same thing as appropriate for every goal. Money you need next year has a different job from money you may not need for 15 years. The other big story was the Federal Reserve. On Wednesday, the Fed released the minutes from its July 28th and 29th meeting. At that meeting, the Fed kept its target interest rate range at 3.5 to 3.75%, but the vote was 9-3, and the three dissenters wanted to raise rates by 1/4 percentage point, and that's important. The majority decided to hold rates steady, but the dissent tells us that some policymakers remain more worried about inflation and believe rates may need to go higher. The Fed's statement said economic activity was expanding at a solid pace, productivity growth and capital investment were strong, and unemployment had changed little. But it also said inflation remained above the Fed's 2% goal, partly because of supply shocks, including higher energy prices. So the Fed is balancing two truths at the same time. The economy still has real strength, and inflation is still not where the Fed wants it. That's why, when will the Fed cut, may be the wrong question right now. The better question is, what do the next several reports tell us about inflation, jobs, spending, and growth? Because the Fed doesn't have to follow the market's preferred storyline. This week's government data also gave us a mixed, not disastrous, mixed picture of the economy. The Federal Reserve reported that industrial production rose 0.2% in July, manufacturing production rose 0.2%, and business equipment production rose 0.8%. And that tells us the industrial side of the economy is still moving forward, even if it's not racing forward. But housing looked much softer. The Census Bureau reported that housing starts fell 12.4% in July to an annual rate of 1.239 million homes. Single-family starts fell 9.9%. So at the same time, building permits, a clue about future construction, rose 5%. So I would not summarize housing with one dramatic word like collapse. Starts were weak, but permits moved in the opposite direction. So 1 month of data is information. It's not destiny. The Census Bureau also reported that second quarter revenue for selected service industries rose 3.1% to roughly $6.4 trillion. So put all of that together, and the economy does not look uniformly weak or uniformly strong. It looks uneven, which is much more common than the headlines make it sound. Oil also mattered this week. Prices moved higher as investors watched conflict and supply risk in the Middle East. And oil is not just a line on a commodity screen. Higher energy costs can reach households through gasoline and utilities, and businesses through transportation, manufacturing, and shipping. And that's one reason bond investors and the Fed are paying such close attention. If energy prices stay elevated, they can make the inflation path harder, even if some of the increase is temporary. The key word there is if. Nobody knows with certainty where oil will go next, so this is something to monitor, not a reason to rebuild your entire portfolio over the weekend. So what does all of this mean for you? Well, first, a down week is not, by itself, a reason to abandon a long-term plan. And second, if you are approaching retirement, make sure the money you expect to spend in the next few years is not relying entirely on the stock market being cooperative on your schedule. That may mean reviewing your cash reserve, your short-term income needs, and the balance between stocks, bonds, and cash. Not because I'm predicting a crash, but because markets are unpredictable and retirement withdrawals are not optional. Now third, check your diversification. If one rough week for technology makes your entire portfolio feel like it's falling apart, you may own more concentrated risk than you realize. And fourth, do not make a permanent decision because of a temporary headline. You do not need to react to every Fed comment, every oil price move, or every red day. You need a portfolio that matches your goals, your time horizon, your need for income, and your ability to live through volatility without panicking. Next week, I'll be watching 3 things. Number 1, new home sales from the Census Bureau on Tuesday. After this week's sharp drop in housing starts, that will give us another look at housing demand. Number 2, durable goods orders on Wednesday. That report helps us see whether businesses are placing orders for long-lasting products and equipment. And number 3, and probably the biggest one for the Fed, the July personal income and outlays report are due Wednesday. That includes the PCE price index, the Fed's preferred inflation measure. We will also hear from Fed Chair Kevin Warsh at Jackson Hole, and investors will listen very carefully for how he describes inflation, economic growth, and the path of interest rates. And on the company side, NVIDIA's earnings will be closely watched because AI-related companies have become such a large part of the market. One company is not the economy, but when a company has that much weight and attention, its results can move the broader indexes. The calm money takeaway this week is simple. The market had a difficult week, but the economy did not suddenly fall apart. Growth is uneven. Inflation remains a concern. Long-term interest rates are putting pressure on stocks, and the Fed is not speaking with one perfectly unified voice. That is uncertainty, but uncertainty is not the same thing as disaster. Your job is not to predict every market move. Your job is to build a financial plan that does not require perfect predictions. And if this helped make this week's financial news feel a little less chaotic, follow Money with Stephanie and share this with somebody who wants to understand the market without being scared by it. I'm Stephanie, helping 1 million people feel calm and confident about money one steady step at a time. And remember, this is education only, not financial tax or legal advice.